Will there be a housing crash in 2023? As I go to the holiday parties and check in with folks and socialize, I'm amazed at how many people are convinced that there will be a housing crash in 2023. Now, I find this fascinating because we've been hearing about a housing crash since 2020, and that was 2 years ago. Remember 2 years ago, April 2020, when everything shut down no matter where you were? It was crickets. Then the experts predicted that you'd see a 6% decline in your home's value, and the housing market was crashing like 2008, and that was on everybody's mind. And guess what? None of that happened. In fact, if anything, the market went crazy. People sold and bought houses, learned to work from home. Home values shot up, and in some cases, they shot up double digits, depending upon where you were located and your neighborhood amenities. Now, fast forward to 2022, and again, we're looking at how everyone got their 2022 predictions wrong. Federal Reserve thought they had inflation under control, but boy, were they wrong. The experts thought that the inflation spike was just a temporary little blimp, but we found out that this inflation turned out to be an explosion reminiscent of 4 decades ago. And housing, which looked like it was going to be a repeat of 2021's highs, started to fizzle back in April. So as we end 2022, I want to take a moment to take a brief look back at what we saw this year, and then report what the experts are predicting we should be expecting in 2023. This should be interesting. Now remember, I don't have December's numbers yet because all of our numbers are always in arrears, and the report for December 2022 will come out in January, and I'll update you then. Right now, looking back at January through November, starting with homes for sale, we see in January that they were down a whopping 16.7%, but by the time we hit March, they were up 4.3% for homes for sale year over year. But then in April, listings for sale plummeted 35%. At the same time, sold and closed homes were down from the 8.7% in January year over year to 26.3% year over year in April. And days in the market really weren't changed too much. They hovered between 4 or 5, rocking back and forth each month. Sold prices held strong in January. They were up 18.4% year over year and jumped to 21% year over year for February and March, but then went up only 4.4% increase year over year in April. Ouch. Weeks of inventory hovered around 1 to 2 for most of January through March, but then jumped to 7 in April. Now, I keep bringing up April because that's when the Fed, wanting to fight inflation, raised the federal funds rate, and they raised it high, and they raised it quickly, giving everyone pause. And that's reflected in these market numbers that we're reviewing. Now, in May, June, and July, rates adjusted downward a bit, and we came back to a little more of what we had been seeing over the last few years. But in May, we actually saw inventory of homes for sale increase by 10.4% year over year, the first time we'd seen an increase of inventory for homes for sale in 2 years. Solds also increased by 1.9%, and days in market still hovered around 4. Sold price increased back up to 14.8% year over year, and days on market decreased to 3. And this is a reflection of what we saw happen in April, where, everything was on pause because of the Fed. And then in May, I think buyers and sellers woke up and said, we're worried about the Fed raising the rates again, so we better sell now if we can. We better buy now, just in case rates jump up again. And then June, July, and August, we saw again a decrease in listings for sale, going from a negative 3.4% to a negative 14%. And we saw a decrease in solds because, of course, the lack of inventory. It was down 26.8%. Days in market, however, went from 5 all the way up to 11 in August. And sold price appreciation was still up, but now it's slowing from the double digits of previous years to an 8.5%. And then in the last little push before fall hit, we saw days in market decrease to 2. Now this fall, September, October, November, we're seeing this trend continue. Listings are down. They were down 14% for September and October, but jumped down to 27.9% in November. Solds were also down 24% for September and October and jumped to 36% down for November. Days in market, however, jumped up to 17 and stayed there for all 3 months. And weeks of inventory have gone from 7 to 9. Sold prices are still increasing, but again, appreciation is slowing. And it's slowing from 8.5% in August and September and October down to 7.2% year over year in November. Again, some of that's reflective of the interest rates that are jumping all over the place this fall. But also, this is the time of year where a lot of people, unless they really need to move, don't think about selling or buying around the holidays. Currently for the week of December 26th, mortgage rates have held relatively steady as most economic news came in better than expected. Consumer confidence has bounced back upward to its highest level since spring. And the third quarter's GDP was once again adjusted upward for a final 3.2% reading. The core reading of the PCP price came in at 0.2, providing more hope that some of these inflationary pressures are finally starting to lighten up. However, since the Fed began waging war on inflation, the housing market is bearing most of the strain. Existing home sales are down. New home sales beat expectations last month with a 5.8% increase. However, they're still 15% lower than 1 year ago. And existing home sales are down now 37% since the start of 2022. And as we enter this last week, mortgage rates appear to be poised to remain mostly steady in the hopes that next year will bring good news, the battle against inflation. As home sales slow and fears of home price declines grow, some people are concerned that we're heading into another 2008-style housing market crash. And many homeowners are still haunted by the 2008 market when property values did crash and foreclosures seemed to be everywhere that you looked. Now, Lawrence Young, chief economist for NAR, the National Association of Realtors, feels we won't see a dramatic downturn. At the recent National Association of Realtors annual Real Estate Forecast Summit conference, where leading housing economists offered their 2023 perspective for the real estate industry, Young pointed to several key indicators of how this market is different from the one we experienced in 2008. The labor market remains strong, he said. In the last major housing downturn, there were 8 million job losses in a single year. Now, even though there are layoffs in the technology, mortgage, and title industries, they haven't accumulated enough to form a net job loss. And a strong job market bodes well for housing's future. There's also less risky loans. Young noted that the subprime loans that were prevalent during 2008 housing busts are basically non-existent today. And then there's underbuilding and inventory shortages. New home construction prior to 2008 crash was amounting to 7.6 million units annually. Today it's 4.6 million units. So a massive housing shortage from a decade of underproduction in the housing market is what Young is seeing. Delinquencies are low. About 10% of all mortgage borrowers were delinquent on their loans back in the 2008 market during the housing bust. But mortgage delinquency rate now is 3.6, holding at historical lows. And there's also ultra-low foreclosure rates, according to Young. In 2008, it was 4.6% during the last housing crash, because people saw their property values plunge and they walked away from their loans. Today, the percent of homes in foreclosure is only 0.6%. Now, while 2022 may be remembered as the year of the roller coaster housing market, inflation soaring to a 40-year high and rapidly rising mortgage rates, 2023 may become a more normal year with long-lost sanity finally returning to the market. Mortgage rates are expected to stabilize, while home sales and prices will become a little more moderate after the recent highs, according to NAR's forecast. However, the details will be different region to region and, of course, neighborhood to neighborhood. So this is a great time to reach out to your trusted realtor, or me, if you're located in the South Denver metro area. We can monitor how your home value is doing. Or, if you're thinking about buying, where to find the best deals. In the meantime, Young stated some housing markets may see an uptick in home buying activity at the beginning of the year, especially if mortgage rates continue receding from the recent high of 7%. He also said that ongoing housing supply challenges will prevent home prices from falling, though price appreciation will slow. He sees many hopeful signs for early next year, and I do too, based upon these numbers. Young is predicting that after the big boom over the last 2 years, that there'll essentially be no change nationally in home prices in 2023. If inflation continues to slow and the rates continue to stabilize, that could bring more buyers back into the market and boost the demand for housing again. Other leading housing economists also gave their take during NAR's Real Estate Forecast Summit conference. Realtor.com chief economist Danielle Hale was upbeat about the prospects of property appreciation, and she's projecting a 5.4% increase in existing home prices for 2023. She thinks home price growth will be half of what it was in 2022, and is even predicting some months where it might be year-over-year declines in value, but overall she believes due to the housing shortage, home prices will still remain high. She also expects shoppers to continue to grapple with housing affordability in the new year and is predicting mortgage rates to average 7.1% by 2023, higher than NAR's prediction of 5.7%. Danishka Kakara Skillington, Assistant Vice President of Forecasting and Analysis at the National Association of Homebuilders, says she expects housing starts to drop by double digits in 2023. Then, as the economy improves, she's thinking that 2024, the housing market will gradually come out of the slump that she expects next year. Now, this might be due to the fact that builder confidence fell over the last 11 months as mortgage rates rose and buyer traffic slowed dramatically. According to Danishka, 59% of the builders have reported using incentives like mortgage rate buydowns and price cuts to tempt buyers back to builders. And they're also facing labor shortages, availability shortages of materials, higher costs for materials, preventing even more construction. Again, adding to our lack of supply. Salma Heb, CoreLogic's interim chief economist, stated that there's a different sentiment happening, and she calls it a crisis of consumer confidence. Sellers are contending with not wanting to reduce their prices because remember what the neighbors sold for, and buyers are seeing the headlines that said prices will come down, but they're also finding now that their purchasing power has been decreased due to the higher interest rates. CoreLogic is now predicting that home price growth is expected to slow to 8% in December and then 0 by the spring of 2023. But they also said that they believe it will vary greatly across the country and that the rate of growth or decline will depend upon the area. They're predicting that markets like San Francisco and Seattle and Las Vegas and Phoenix, all of which saw home prices increase greatly during the pandemic, could experience the most home value decline of up to double digits of almost 12% because of the loss of consumer confidence and worries about being upside down once they purchase. So there you have it. The experts' opinions, the predictions, right? Now we have to remember again that real estate is very much a local business driven by the local economy. So if you're thinking about buying, I personally believe now is a good time based upon this information. Rates have gone down a little bit and sellers are willing to work with you this time of year. And if you're thinking about selling, from the numbers that we've been reviewing that you're sitting on some very, very nice home value appreciation. The takeaway from this really is it seems like every year we listen to the experts and the economists, and they're constantly getting caught off guard by the unexpected. And if the last few years have taught us anything, they've taught us to approach this coming year with a willingness to expect the unexpected. Hi, my name is Peggy Dursthoff with Live Denver Suburbs, powered by HomeSmart. And if you like this video, check out this one over here, where I talk about whether or not it's good to buy a house now. Thank you so much for watching, and I'll see you next week, which is next year.